Right, let's not waste your time. HMRC is watching. I know how that sounds, a bit dramatic, but this isn't a scare tactic. This is what we're seeing in our office every single week. Letters landing on clients' doormats that start very politely and then within about 3 weeks turn into something that costs them tens of thousands of pounds. And here's the bit nobody tells you. Most of these inquiries don't start because somebody has done something properly dodgy. They start because of small, lazy, completely fixable mistakes that just get left too long until HMRC's computer notices. In this video, I'm going to walk you through the 5 red flags that we see trigger investigations the most, why they matter, and exactly what you do about each one. And stick with me to the end, because the 5th one is the one that catches out the people who think they've got everything in order. The smug ones, basically. You know who you are. Right, number 1. If your declared income says one thing and your life says another, you are already on HMRC's radar. You just haven't had the letter yet. Now, this used to be the bit where the local tax inspector might have heard something at the golf club and had a quiet word with somebody. Those days are long gone. HMRC now runs a system called Connect. It cost about £100 million to build originally, and last year alone it brought in £4.6 billion in extra tax. 4.6 billion. That's not a typo. Connect pulls data from over 30 different sources. Your bank accounts, PayPal, Stripe, eBay, Etsy, Vinted, Airbnb, land registry, so every property you buy or sell, DVLA, so every car you register, Companies House, crypto exchanges from January this year, foreign tax authorities from over 60 countries. It even pulls in data from letting agents. And here's the bit that really catches people out. Online platforms are now legally required to send your transaction data straight to HMRC. Not they can if asked, they have to. eBay, Vinted, Etsy, Airbnb, Just Eat, they're all reporting. So if you sold a few bits on Vinted last year and thought, it's only a couple of grand, no one will notice, I've got news for you. They already know. The data's already with HMRC. They're just waiting to see if you declared it. So Connect builds a profile. Your income, your assets, your spending, your digital footprint. And it looks for one thing: mismatch. Where the picture it builds doesn't match the picture you've painted on your tax return. Quick example. You declare £42,000 of self-employed income. Reasonable, nothing flashy. But Connect sees a buy-to-let on the land registry under your name. A Range Rover registered with the DVLA last August. 3 eBay receipts for designer watches totaling £6,000, and £18,000 of unexplained deposits across your personal accounts. Connect doesn't think you're necessarily guilty, it just thinks this doesn't add up. And once it doesn't add up, a human at HMRC gets a list with your name on it. Now, real example. Client came to us last year. He's a self-employed plumber in the Midlands. Lovely bloke. Declaring around £38,000 a year. Quite consistent, nothing dramatic. Then he got a letter. HMRC opened an inquiry. We asked why. Turns out his Facebook page was the problem. Not even Instagram, mind you. Facebook. He'd posted photos from a stag do in Las Vegas. New conservatory going up. 2 holidays in the same year, one of them a fortnight in Mauritius. And a video of him collecting a brand new VW transporter. Sign written with his business name on the side, very proudly. Now, individually, none of that proves anything. You can have all of that and still be entirely legitimate. He'd had an inheritance. He'd remortgaged. The Mauritius trip was paid for by his partner. All explainable. But here's the problem. His records were a complete shambles. Receipts in a shoebox, business and personal money flowing in and out of the same account, cash jobs that were sometimes recorded and sometimes not. And once HMRC start digging and your paperwork can't tell a clean story, they fill in the gaps themselves. And they don't fill them in generously. It took us about 4 months to sort it. He paid an extra £14,000 in tax, interest and penalties, most of which, honestly, was avoidable if his bookkeeping had been even half decent. So how do you stay off this list? Separate your accounts. Business income into a business account. Drawings or salary out to your personal account. That's it. Clean line. We've had inquiries shut down in about 3 weeks because the bank trail was so clean, HMRC couldn't be bothered to dig further. If you sell on Vinted, eBay, Depop, Etsy, declare it. Even if it's small, the data's already with HMRC, so the worst thing you can do is leave it off and hope. And if your lifestyle has changed because of a one-off, inheritance, gift, remortgage, partner's income, anything, keep the paperwork. Bank statement showing the money in, letter from the solicitor, whatever it is. Because the moment HMRC asks you to explain a deposit, I think it was my mum, is not an answer that will land well. If any of that felt a bit close to the bone, this is exactly the kind of thing we help clients tidy up before HMRC gets there first. Links in the description. Right, on to number 2. And this one is where people think they're being clever, but they're really just lighting a flare. Everybody wants to reduce their tax bill. That's not a crime, that's just sensible. It's literally what we get paid to help people do. But there is a line between being tax efficient and being, frankly, ridiculous. And HMRC's systems have got very, very good at spotting where that line gets crossed. Connect doesn't just look at what you earn, it looks at what you claim, and it benchmarks you against everyone else in your industry. So if you're a freelance graphic designer in Manchester and your expenses are running at 70% of your turnover, while the average for your industry sits around 35%, you stand out. Not in a good way. Let me give you an example. We had a referral come in earlier this year. A landscape gardener, self-employed, turnover of £58,000. So far, so normal. His expenses, £41,000. Now, gardening is materials heavy, fair enough. Plants, soil, tools, fuel, van costs. But 41 grand on 58? That leaves him living on £17,000 a year in Surrey with 3 kids. HMRC's first question wasn't even aggressive, it was just practical. How are you living on this? And once they ask that question and you can't answer it convincingly, the conversation gets uncomfortable very fast. Turned out he was claiming for his wife's car, the full whack. She wasn't in the business. He was claiming food bills as client entertainment because he sometimes had a sandwich on a job. He was putting through his Sky subscription because, and I quote, "I watch gardening shows for research." Look, I know, we laugh too, but HMRC don't. They disallowed nearly £19,000 of his expenses, backdated 4 years, slapped on interest, added a penalty for careless behaviour. The bill came to just under £22,000. For a bloke turning over £58,000 a year, that genuinely hurt. And this is where Connect gets clever, because it's not just looking at the absolute numbers, it's pattern matching. If your industry average for mileage is 8,000 business miles a year and you're claiming 24,000, you'll get a flag. If your home office claim is suddenly £4,000 when you've got a small flat in Croydon, you'll get a flag. If your subsistence suspiciously matches every Wagamama in central London, well, you can see where this is going. The rule, and it's been the rule for about 100 years, is wholly and exclusively for the purposes of the trade, which is HMRC speak for you can't claim for stuff you'd be buying anyway. Your Spotify subscription is not deductible because you sometimes listen to it while invoicing. I'm sorry, it just isn't. So what do? Be sensible. Only claim what you can defend with a straight face. Keep receipts, not for everything, but for anything over £20 and absolutely anything that could be challenged. Use a separate business credit card for business spending. It creates a paper trail without you having to do anything. And if you're claiming anything that's a big number, mileage over £3,000, home office over £1,000, repairs or refurbishments on a property, equipment purchases over £2,000, get a sanity check before it goes anywhere near a tax return. We do this dozens of times a year for clients. It's a 15-minute conversation that saves them 5-figure investigations. Quick aside, if you want more of this kind of plain English HMRC stuff, hit subscribe. It's properly the cheapest insurance you'll ever take out. Costs nothing and might save you from an inquiry you didn't see coming. All right, number 3, and this is where cash handling businesses need to pay attention because HMRC have got very, very sneaky about this one. Cash isn't illegal. Let's start there. Despite what some people seem to think after COVID, you are perfectly entitled to take cash for your goods and services. The Bank of England still prints the stuff, for now. But cash is harder to trace, which means HMRC pays much, much closer attention to it. And this isn't just hospitality. Yes, restaurants and takeaways get a lot of focus, but we also see this with barbers, beauty salons, market traders, taxi drivers, mechanics, mobile car washes, kebab shops, dog groomers, anywhere cash still moves around. If you're in a sector where cash is normal, HMRC has a benchmark for you, and they'll test you against it. The thing they're really looking for is what they call income suppression, which is a polite way of saying you took the cash and didn't put it through the books. And they don't need to catch you doing it, they just need the numbers not to make sense. Here's how they test it. They cross-reference your declared turnover against your card machine data, which they get straight from your payment provider, against your supplier invoices, against your stock purchases, against your utility bills, against your staffing rota, if they can get hold of it, against your opening hours. They even look at your social media to see how busy the place looks on a Friday night. So if your card takings are £180,000 a year, but you've declared £190,000 total turnover, HMRC is going to ask, where's the cash? Because in a takeaway, the cash to card split is usually somewhere between 20 and 40%. So if your card is doing 180k, your real turnover is probably closer to 230 or 240k. And the £50,000 difference, they want a word. Now here's a real case. This is properly mental, and it happened to a client of ours about 2 years ago. He ran a barber's in North London. 2 chairs, busy little place. HMRC opened a VAT inquiry, supposedly random. Asked for records covering a very specific 3-day window. Tuesday, Friday, Saturday. Not a month, not a week, 3 specific days. We pulled the file. Looks normal enough. So we asked HMRC, under our right to request the data they were relying on, what they actually had on him. Turned out, HMRC inspectors had been in, multiple times, in pairs, over those 3 days, pretending to be customers, paying cash for haircuts, then comparing what they paid against what the till and the books showed. They'd also been parked across the street, counting customers going in and out. They counted 142 customers over those 3 days. Our client's books showed 96. That's a 32% gap. We unpicked it eventually. Turned out about 18 of those customers were actually deliveries. Mates dropping in and the bloke from next door who pops in for a tea. And a couple of the haircuts the inspectors had recorded as paid in cash had actually been on the card terminal. They hadn't realised because they paid one inspector with cash and another paid by card on a different visit, and the records crossed over. But here's the thing. Even after we sorted it, the inquiry took 8 months. He paid about £6,000 in extra tax to settle some genuine gaps in record keeping, plus our fees, plus the absolute stress of it. And this wasn't a random check. HMRC was running this exercise across the country. Hundreds of cash businesses got the same treatment. So how do you protect yourself? Keep it dull. Record every single cash sale on the day in some form of digital system. Reconcile your till to your banking every single day. Your stock should match your sales. Your card to cash ratio should be consistent month to month. If it suddenly shifts, there should be a reason you can point to. Bank your cash regularly. Don't sit on it. Cash sitting in a drawer for 6 weeks, then getting deposited in one big lump, looks suspicious, even when it isn't. And if you're in a cash business, please get an accountant who actually understands cash businesses, not somebody who just does limited company year ends from their dining room. There's a real difference. Right, on to number 4. This one is the one HMRC uses as the front door for everything else. VAT is, more often than not, where an HMRC inquiry starts. But VAT is hardly ever where it finishes. The VAT threshold in the UK is currently £90,000 of taxable turnover on a rolling 12-month basis. So not your tax year, any 12-month window. Cross that and you've got 30 days to register. Don't, and HMRC backdates it, which is messy and expensive. Now, HMRC's VAT systems love patterns. They love consistent businesses. They love filing on time, paying on time, declaring sensible numbers. And the moment you break a pattern, they notice. Here are the 4 patterns they notice fastest. 1. Hovering just under the threshold. If your turnover has been sitting at £87,000, £89,000, £88,500 for the last 3 or 4 years, never quite crossing £90,000, HMRC is going to ask why. Because that's statistically unusual. Most growing businesses either grow through the threshold or stop short of it by a comfortable margin. Sitting exactly underneath year after year looks like you're managing your numbers to avoid registering. And that, my friend, is called bunching. It's a flag. 2. Repeated nil returns or constant reclaims. If you keep filing nil returns when your card machine clearly shows sales, that's a problem. Or if you're constantly claiming VAT back, reclaim, 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 and your sales never seem to catch up, that's a problem. HMRC's IDRS system, which is what replaced the old truce, holds your reclaim until they're satisfied. And they will ask questions. 3. Disaggregation. Now this is the big one. Disaggregation is when you split one business into 2 or 3 smaller ones to keep each under the VAT threshold. Husband runs the cafe, wife runs the catering business, same kitchen, same staff, same customers, two sets of books, neither one VAT registered. HMRC has been all over this for years. They test for three kinds of links: financial, economic, and organisational. So shared bank accounts, shared suppliers, shared staff, shared premises, shared customers, shared branding. One entity invoicing the other constantly. Find two of those links and HMRC can rule it's a single business and backdate VAT across the lot. We've seen disaggregation cases where the backdated VAT bill alone was over £80,000, plus penalties, plus interest, plus the legal cost of fighting it. And by the way, HMRC can look back 20 years on this one. 20 years. If they think the separation was deliberate from day one, they can go all the way back. 4. Late VAT returns when there's nothing to pay. People think, oh, I owe nothing this quarter. It doesn't matter if I'm a week late. It absolutely matters. Late returns flag your account. They suggest your records aren't under control. And once your account is flagged, HMRC starts looking at everything else. So how do you stay clean? File on time. Pay on time. If you're approaching the VAT threshold, talk to an accountant before you cross it, not after. If you run multiple businesses, make sure they're genuinely separate. Different staff, different bank accounts, different suppliers where possible, different customers where possible, and properly arm's length contracts between them. And honestly, if you're hovering at £87,000 a year on purpose to stay under VAT, ask yourself if that's actually the right strategy. Because the flat rate scheme exists, margin schemes exist, and the cost of getting it wrong is usually way higher than the cost of just registering and getting on with it. Right, one more. And this is the one that gets the people who think the first four don't apply to them. This is the one nobody takes seriously until it's too late. You can have spotless records, clean bank trail, sensible expenses, everything beautiful, and you can still end up on HMRC's bad list by missing one deadline. Here's the current penalty structure for self-assessment. Miss the 31st of January deadline by 1 day, and I mean 1 day, even a minute past midnight, and you get an automatic £100 penalty. That's automatic, no discussion, no appeal unless you've got a properly good reason. Even if you owe nothing, even if HMRC owes you money, £100, gone. 3 months late, that becomes £100 plus £10 a day for up to 90 days. So you're now staring down £1,000. 6 months late, another £300 or 5% of the tax due, whichever is higher. 12 months late, another £300 or 5%, and in serious cases, up to 100% of the tax due if HMRC thinks you've been hiding income. That's just filing penalties. Late payment is separate. Interest starts running from the day after the deadline, currently 7.75%, which compounds daily. Then you've got a 5% late payment surcharge at 30 days, another 5% at 6 months, and another 5% at 12 months. So in a worst case, you're looking at the tax bill plus 15% in surcharges, plus a year's worth of interest, plus the late filing penalties on top. We've seen people turn a £4,000 tax bill into £9,000 just through missed deadlines. But now, and this is the bit a lot of people don't know yet, from April 2026, the whole game changes for sole traders and landlords. Making tax digital for income tax has just launched. From 6th April 2026, if your gross income from self-employment and property was over £50,000 in the 2024-25 tax year, you have to use MTD. Digital records, MTD-compatible software, quarterly submissions, plus your final declaration at the end of the year. April 2027, the threshold drops to £30,000. April 2028, it drops again to £20,000. So by 2028, almost every sole trader and landlord in the country is in MTD. And the penalty system changes too. Instead of an immediate £100, MTD uses penalty points. You get 1 point per late submission. Hit 4 points, you get a £200 fine. Every further late submission after that, another £200. There's a 12-month soft landing for the first wave, which is generous. But after April 2027, no more soft landing. And the late payment penalties under MTD are actually harsher. 3% at 15 days overdue, another 3% at 30 days, then 10% per year accruing daily. So look, if you're in that first wave, over £50,000 income, sole trader or landlord, you should have software in place by now. You should have signed up. If you haven't, you're already behind. Quarterly reporting punishes disorganization. If your books are messy under annual filing, they will be a disaster under quarterly filing. And the people who keep missing deadlines repeatedly, year after year, HMRC stops waiting. They start estimating what they think you owe and sending what's called a determination. And those determinations are always pessimistic. Always. They assume the highest plausible income and the lowest plausible expenses. Then they enforce it. We've seen clients get a determination demanding £18,000 when their actual liability was £3,400, and they only had 30 days to challenge it. Don't be the person trying to fight that with a shoebox. So this one's simple, really. File on time. Even if you can't pay, file. Filing late and paying late is two separate sins. Don't combine them. If you can't pay, set up a time to pay arrangement. HMRC actually does these all the time, and they're generally pretty reasonable about it as long as you ring them before the deadline. Get software. Set reminders, use a diary, get an accountant who chases you, whatever it takes. Because HMRC is dramatically more forgiving when you're proactive and dramatically less forgiving when you go quiet on them. And that brings us back round to the start, really. Because most HMRC investigations don't start with fraud. They don't start with somebody trying to pull a fast one. They start with the boring stuff. A missed deadline, a messy bank account, an expense that looked fine when you claimed it and looks less fine when somebody asks about it. A bit of cash that didn't quite make it onto the books. If you stay organised, stay consistent, and deal with problems early, when you spot them, not when HMRC spots them, you massively, massively reduce your risk. Almost every single inquiry we've handled in the last 10 years started with a letter, a polite letter, saying something like, "We'd like to make some inquiries about your 2022-23 tax return." That letter doesn't mean you've done anything wrong. It means something doesn't match. The danger isn't the letter. The danger is what you do next. People panic. They reply emotionally. They send half the documents asked for, then 6 months later send the other half. They go silent for weeks. They guess answers when they should say, "I don't know, let me check." Every one of those things turns a small inquiry into a long, expensive nightmare. A calm, well-organised, professional response, even to a scary letter, can end an inquiry in 3 or 4 weeks. A panicked one drags on for years. So that's the 5. Lifestyle mismatch, dodgy expenses, cash-heavy records that don't add up, sketchy VAT behaviour, and missed deadlines. Get those 5 under control and you are about 90% of the way to never hearing from HMRC except when they send you a refund. If you found this useful, hit subscribe. We do these every week. And if any of this hit a nerve, if you watched the first red flag and thought, get in touch. There's a link in the description. We'd rather sort it now than meet you in the middle of an investigation in 18 months' time. I'll see you next time.